Joining us right now, talk about the expectations for the Fed. Roger Ferguson, former Fed vice chairman and a CNBC contributor, somebody who I've said it before has gotten this right, probably more than just about everybody we've had on this broadcast about what the Fed would do. The question is, what will they do next? Obviously, there's an expectation of at least one more rate cut, if not two.
Hike.
And we're all trying to figure out. Excuse me?
Rate hike.
What did I say?
You said cut.
Cut?
Yeah.
Did I say cut? Oh, hike.
We knew
hike.
what you meant.
Thank you, Roger. So the big question is whether you think with this market melt up or whatever you think's happening, that actually makes it more likely that we get a rate hike, not a rate cut. My apologies.
Well, certainly the first rate hike is certainly baked in. I think there are a number of factors that might encourage that second rate hike. First, they've already mentioned that as a possibility. And secondly, as you point out, the economy is continuing to do very well, fortunately, giving them room for one more move if that's what the data call for.
And after that, what do you think? Where do you think this all goes?
Look, I think they are really what they say they are, which is data dependent. We are pretty pleased, but I think they were also pretty pleased with the last print from the CPI. But it's far from over that they're getting inflation definitely down to that 2% number. And I think part of the problem is inflation still might be stuck a little higher than 2%, forcing them maybe to do not one more after July, but possibly two, if that's what the data called for. So I think too early to say only one, certainly too early to say two. We'll wait and see.
I'm glad you said fortunately with the economy, because I would hate for the Fed, in light of those good inflation numbers, Roger, and you're right, we're not where we want to be, but they were certainly friendlier than people thought. I'd hate if the Fed just said, wow, we just aren't making any progress slowing this economy and raising unemployment. We should just do it just because we need to do it, because we're not orchestrating even a soft landing. Maybe we're not orchestrating anything at all. That would be a bad rate, but you tempered that with saying that they'll be data dependent. If inflation cooperates, you don't hike rates just because the economy's strong, do you?
Oh, you're absolutely right. Their job is to get inflation under control. They've said they're aiming at a 2% target, and they want to be very convinced that inflation is moving in that direction. Once that's established, the other part of their dual mandate, which is to create maximum sustainable employment. So I think they are at this stage balancing both stronger focus on inflation, but once inflation is under control, I think they would be relieved to be able to say, job done. Not there yet, however. Not there
Roger,
yet.
do you have any different view of where you have been about a soft landing versus a recession? I think you have been in the recession camp, and I ask that because, as we've seen over the last 10 days, at least the market, I think, is now not necessarily expecting a recession.
So the reason I was in the recession more likely than not camp is the fact that inflation, it does appear still to be sticky. Back to the question that we heard from Joe, the possibility of having to go a little further, I think, is the risk. That's the underlying theory of why recession is possible, which is the inflation stays sticky. The Fed has to move not one, not two, maybe three more times. Nothing has changed my view yet as that being a risk. But I'm hoping, as with everybody else, that inflation moves down more quickly and the soft landing becomes more possible.
But put your investor hat on. Have you watched these 10 days and marveled at it and said, this makes a lot of sense to me? Or have you watched this and said, this doesn't make sense?
I'm more in the camp of, gee, I hope that they're right, that underlying earnings, underlying momentum is still powerful enough, and inflation proves that it's not intractable. But I'm not there yet. So I'm more in the scratch my head, hope they're right, but I'm not sure I'm completely convinced that the market's calling on this one just yet.
Can you take us, as I always like to ask you, sort of inside the Fed from your days there, in terms of how you think Jay Powell is going to talk about things later this week, and then more importantly, I don't know if it's more important or not, how he may talk about things at Jackson Hole, when that speech gets written, if you will, and how many adjustments are made up until the last moment?
I think the way he's going to talk about things this week, assuming that they in fact do the 25 basis point move that's baked in, is I think he's going to want to keep the next two meetings, as they say, live meetings. I don't think he wants to signal that they are in any sense done, because one, they're not, and two, that has broad implications to the point that you just raised. I think vis-a-vis Jackson Hole, I think maybe that's a more thoughtful speech, so to speak. And there, I think maybe laying out the so-called risk management approach, how they're thinking about things from here on out, having to weigh the risk of doing too much versus too little. That might be a nice way in Jackson Hole to sort of create context and move us from meeting to meeting to a broader, underlying thesis of how the Fed thinks.